Hello dear students. In this lecture we are going to discuss the ledgers or the T accounts. In the last lecture we discussed the double entry and hopefully you remember the principles of the double entry. That the principle of the double entry is the duality concept, and on the basis of the duality concept what we are doing is we are recording a transaction in the form of debit and credit. These are the two impacts which we are recording in the form of debit and credit. Now we are moving towards the ledger or the T account. Basically, sometimes we call it ledger, or sometimes we just simplify it by calling the T account. Why we call this T account? Because it looks like a T, and we'll be looking uh, the shape of the T account shortly. The first thing you need to understand is the accounting cycle. Now, this is the most simplest form right in front of you of the accounting cycle. Most simplest form. Now, by the most simplest form means that maybe you find a more extended version somewhere, like it shows sometimes 8 steps, sometimes 9 steps, because they have this extended each step into 2 or 3 further steps. But we are looking at the most simplest form right in front of you, which shows the accounting cycle. Now, the accounting cycle means that ultimately we will be preparing the final accounts. Now, final accounts means the financial statements. Financial statements are the statements which shows the financial performance and position of the company, such as statement of profit or loss. It shows the profit or loss made by the company. Such as the statement of financial position, it shows the assets, liabilities, and capital of the company. Ultimately, what we will be doing is we will be making the final accounts for the shareholders. But now these final accounts are made in a stepwise approach, which is known as the accounting cycle. You started the business transactions, and the first thing you did was the journal entries. That means the double entries. Now you are doing the second step. You will be putting these double entries into the ledger. And then once we are done with the ledger, we'll be moving towards the trial balance and then the financial statements, which is also known as the final accounts. So this is the most simplest form of accounting cycle right in front of you. So there's a business transaction. First of all, you make a double entry from it. Then you put that double entry into a ledger, and then you make a trial balance, and finally the financial statements are prepared. Now this is the double entry right in front of you. You have the debit and the credit, and you debit and credit by the name of the account. For example, you are buying inventory. So what you do is debit purchases and credit cash or payable if you have bought the inventory on credit. This is the amount which you write it over here. Similarly, if you are paying the electricity expense, so you debit the electricity expense and then you credit the cash or the bank, whatever. Now, these are the double entries which you did in the last lecture. Now we are moving further from the double entry. The first thing you need to understand is the format of the T account or format of the ledger. This is a very simple thing. So you look, there is a T, that is why we call it a T account. So this is simply a T right in front of you. This side is the debit side. So this side is the debit side. Right side, left side is the debit side. Right side is the credit side. So debit side, which is the left side, right side is the credit side. So the debit side and the credit side. And then there's the transaction number. There's no need to write the transaction number, but we usually have in the standard format. And this is the name of the account containing the matching double entry. We are going to discuss this thing. What is this? And this is the amount. Usually we have that in dollars. And this is the account name. So the similar things are on the debit side, the similar things on the credit side. This is the T you need to understand. when you are putting the double entry into the ledger. Now we are doing an exercise, and from that exercise, you can understand how we will be putting this thing. So first of all, let's have a revision of the double entry quickly. Ole purchases goods for 5,000. So when you are purchasing goods, you debit the purchases and pays by check, so bank account credit. The amount should be similar, 5,000. Ole makes a sale to a customer for 500. So when we are making a sale, it's a revenue, and revenue or sale when increases, it goes to credit. The customer pays in 30 days time, so we are having a receivable, which is the current asset. Ole pays a telephone bill, which is the expense, and pays by check, so telephone expense debit and bank account credit, because expense is increasing and the bank account, which is the asset, it is decreasing. Ole receives bank interest income. Now income when increases, it goes to the credit side, and we are receiving in the bank, so bank is increasing, debit bank. Ole purchases stationery for 12 and pays cash. So stationery is the expense, so stationery expense debit and cash account credit. Ole make, or you can also make the bank account debit, but usually we are not paying the $12 through check. Obviously we'll be paying the cash, so it makes sense that we are crediting the cash. Ole makes a sale to the customer for $400. Again, sale is the revenue, so sales account sales credit and cash account debit, because the customer is paying in cash. Now this is the basic thing you need to understand. Now we'll be moving towards the T accounts on the next page, but let me simplify for you over here that in what steps we are going to make the T account. First of all, you have to make the T. First of all, you have to make the T. Now, for every entry, there's going to be a separate T account. Like debit purchases, so purchases will be having a T account, then credit bank, and then the bank will be having the T account. Similarly, we have debit receivables, so we'll make the account for receivable, and then credit sales will make account for the sale. We will be having separate T accounts for every debit and credit entry. But if you see over here, like we have the bank over here, we have the bank over here, and further. So that means the bank account, we can make only one T account of the bank, and we will show all the transactions in that. Similarly, we have for the sale, if we are having a sale over here and sales over here, so we can make a one T account which represents all the sales. Otherwise, we will be having the separate T accounts for each of the double entry. Now, the first thing is you make a T and then you write the name. So purchases account, because the first entry is purchases. So purchases, you just pick the name from here and you write purchases account. This is the name of the account. Now you know that this is the debit side and this is the credit side. So purchases are being debit. So what we do, and by 5,000 we write the amount over here, which is $5,000. Now, if I write purchases over here, then you won't be able to understand that how these purchases are done. Look, this is the T account of the purchases, and it is on the debit side. That means you have done the purchases, but the purchases can be done either through cash, it can be done by paying through the check, or it may be on credit. So how would you know how these purchases are done? So you give the reference of the other entry in the T account. So what you do is debit purchases account and you give the reference of the bank. So that if I just, skip the double entry and directly see the T account, from the T account I can see that, okay, purchases are being done by paying through the bank. So that is why we always give the reference of the other entry rather writing the same purchases account. Now you can see the other transaction. We are done with the purchases. Now we'll be putting the bank. So bank account. This is the name. Now bank account is being credited. So what we're gonna do is go to the bank account, okay, write 5,000 amount over here. But if I write the same bank over here, then you won't be able to understand that what we have done from this bank account. But if I give the reference of this transaction, like if I write purchases over here, then you can easily understand by looking at the bank account that, okay, we have done the purchases from the bank. This is how we are going to record the transactions into the ledger. Now, I have made things simple for you. So these are the ledgers of the T accounts right in front of you. And the same entry we are carrying over here. These entries I have just copy pasted over here. So debit purchases, credit bank. Now this is the purchases account, as the name suggests. So we are debiting the purchase account because this is the debit side, remember, and this is the credit side. This is the debit side, this is the credit side. This is the debit side, this is the credit side. And again, for all the T accounts, you should remember this thing. So the first entry we have to put in the ledger is debit purchases. Debit purchases. Now we have just made the T account and we have put the name. This is the name. These are the amounts in dollars. So we are debiting the purchases. So we put on the debit side this 5,000. But if we put purchases over here, then we won't be able to understand that how we have done these purchases from cash, from bank, or on credit. So we put the reference. So debit purchases, and the reference we give over here is the bank. Similarly, we're going to make the bank account. So bank account. Now bank account, this is the name, and then we have the amount. So bank account is credited by 5,000. So we put 5,000 over here on the credit side. But if we write the bank over here, then we won't be able to understand what we have done from this balance. So what we're going to do is give the reference of this transaction. So purchases. Now, if you just see the purchase bank account, you can see that, okay, you have done the purchases from this $5,000. See here the transaction, debit receivables, credit sales. So you have to make one account for receivables and the other account for sales. So we make the account for receivables. The receivable account is being debited by 500, and we're going to give the reference of this transaction. Okay, fine. So we have done the credit sales to the person. That is why we have to receive $500. Similarly, we'll be making the sale account. Okay, sale revenue account. The amount is on the credit side, and we were gonna give the reference of this. That, okay, we have done the sales on credit. That is why it is receivable, because the sale can be on cash. You can receive a check from the customer. That is why you have to put the opposite reference. Similarly, if you see the third transaction, debit telephone expense, so you have to make one account. You have to make one account for expense, and then you have to make one account for bank. But we already have the bank account. So telephone expense, debit side, and we're going to give the reference that, okay, we have paid the telephone bill through bank. And similarly, if you see the bank account, so bank account is being credited by 40, and where we have used this 40, we have paid for the telephone expense. So if we are not putting the opposite references, then you are not going to understand which transaction we have done. Similarly, if you see the fourth transaction, which is debit bank credit interest income, so you see bank account, now it is being debited, and what we have received, where we have received this 150 from interest. Now similarly, we'll make the interest account, it is being credited because it is income, and income account is being credited, and from where this income is coming, in the bank. So you should remember this thing, that we will be making the T accounts from the double entry, and we have to put the opposite reference. If we are not putting the opposite reference, then we won't be able to understand from where these transactions are coming. Hopefully you have understood the topic.